Hello and welcome to another instalment of the BRR Media Industry Roundtable series. I'm your host, Michael Killicoat, and today we'll be focusing on self-managed super funds, in particular residential property. And joining me today to discuss are a couple of industry experts. Firstly, Tanya Sale, the Chief Executive Officer of Outsource Financial. Welcome, Tanya.
Thank you, Michael.
And also Ben Anderson, the Managing Director of Future Estate. Welcome again, Ben.
Thank you, Michael.
Now, firstly, just by way of background, could you just each tell viewers a little bit about your businesses?
Outsource Financial is a national aggregation group. When we say national aggregation group, how best to describe this? It gets very difficult sometimes because a lot of people don't know what an aggregator group is. But we predominantly play in the professional services sector, meaning with planners, financial planners, accountants, the legal fraternity, conveyancers and other groups who are really interested in adding on to their core business. So we assist them in building a lending arm within their own business.
Okay, and Ben?
So our business is residential focused, so Future Estate Group. We provide residential investment opportunities for self-managed super and investors looking to access residential as a part of their investment portfolio. So we're focused on the $400,000 to $600,000 bracket, typically where people can access higher rental returns and stable capital gains over the long term, either within a managed fund or within a direct property purchase.
Okay, so generally why would an investor choose to include property in their SMSF?
Well, after, I guess, consulting their accountant or their planner, it is a great way in regard to taxation benefits. Now, I'm not an accountant or a planner, and we would recommend strongly that they go and seek that advice. But there are many advantages, and even going forward, why they should add property to their portfolio. The lending side of it, of course, it's different to what you would normally go if you were just buying an owner-occupied out there in the market. And if you want later on, I can go through a few of those things that will be different in regard to the SMSF lending space.
I think it's obviously been a big theme in the market. Yeah. There's been a lot of interest for people, both direct investors, but also particularly within a self-managed super fund looking to access residential, and it is perfectly suited for self-managed super because if you think about it, super is a long-term investment where you're looking to get stable returns, both in the form of capital gains and also rental returns, and property has provided that. If you look at almost any horizon that you could select, so 5 years, 10 years, 20 years, 50 years, property has traditionally provided about 7-8% per annum capital growth and has provided reliable rental returns. So historically, the rule of thumb has been that it's doubled every 10 years. We may see a situation, and we're probably starting to see that, where incomes from property are growing, so rental yields are better, and the growth in that rental yield is actually accelerating. We've got some slides on that. So maybe the composition of return from residential property is changing to more income and perhaps a little bit less capital growth. But the fact remains that it's very well suited to a long-term investment vehicle such as self-managed super. We can get relatively reliable long-term returns that's quite stable and people feel comfortable with bricks and mortar. So it's been a bit of a big trend in the last 4 years, and Tanya I think is going to touch on it a bit later about some of the things that have made it easier for people to access property within their fund. So the lending guidelines have changed. That's meant that you can borrow within your fund, and people have logically been attracted then to investing in residential property. At the moment, it's only 3.6% of the total investable funds within self-managed super. So there's $420 billion in the sector, of which 3.6% is residential, but we expect that number will change quite substantially in coming years.
What it does is it's allowed the client then really, hasn't it, to have some variety within their own fund and have control over it as well.
Okay, so back to you, Ben. How are people currently investing in property?
It's interesting that within self-managed super, and it's been around a long time, a lot of people aren't aware that self-managed super really came out in the early 90s, but it's only really hit its straps as far as broader market adoption and awareness. Traditionally, it's been business real property, so usually that's a private business owner that owns their office or owns their, for example, if they're a doctor, owns their medical practice, and the super fund owns that and rents it back to their business. That's been the first way that people have generally got into direct property within their fund. Now that's changing substantially, and some of the trends are the fact that the lending guidelines have changed and made it easier for people. We expect the interest has been quite overwhelming in recent years. I mean, there's been a need for the industry to start providing investment opportunities, both in the form of your traditional house and land, or just off the plan apartment purchase or traditional apartment purchase, but also now there's evolving sector providing investment opportunities in the form of managed funds, where you can actually end up with direct property ownership at completion. So there's a lot of complexities with the SIS Act, which is the act guiding, regulating self-managed super, that mean that you can't undertake, for example, developments, or it's very difficult to do so in your fund. So one of the things we provide is an ability for investors to effectively access the returns, so you can get the higher returns you can get from property development, but end up with a physical apartment or townhouse at completion. So it's direct property in your fund.
Okay, are there some other alternatives in the market that investors can look at?
Yeah, look, it's interesting because it's still in the formative stages. So some of the fund managers are starting to think about how they could provide products for self-managed super. Interesting, I noticed Charter Hall came out with a syndicate targeting self-managed super as their primary investor base, and that's actually a bit of a first. We haven't seen that before, but I think we're going to see a large trend towards this because there's a big demand, and investors are wanting ways to get the higher returns that you can sometimes get under a collective pooled structure. But generally what we're seeing is the primary driver that they like about residential property is that direct ownership and control that goes with it. So at completion of a particular project, investors own that apartment, can rent it out, can sell it, can do as they wish with it.
Okay, now just turning to the funding side, Tanya, what are the key points that investors should keep in mind when investing in residential property?
Well, I think on the lending side, as I alluded to before, Michael, it's different. Now, normal lending, you would go to the lender or to your mortgage writer and you'd have your pay slips. If you're self-employed, you'd have your tax returns, you'd have evidence of your deposit, etc., etc. Not so with this SMSF lending. The serviceability calculation is entirely different. So the investors should realise, or not even realise, I guess just have that knowledge going forward if they want to do this, that it's going to be different. The banks look at the contribution of what the investor has contributed into their super for the last 12 months. That goes towards serviceability. They would then take into calculation the expected rental on that investment property going in. So there's the serviceability policy there, and there's only two. Some lenders take into consideration, I guess, the assets allocated in the super fund. If they're deriving any income, they would normally take that in. But again, every lender is different, and the investor, I guess, has to really look into it because every lender is different. The loan to valuation ratio is different. I guess the product features are different, the terms are different, and I guess the list would go on. So what we do at Outsource Financial is we only allow a certain number of our writers to write SMSF lending because it is a specialised area.
And I guess one thing that for the average person that doesn't have a lot of detailed knowledge of self-managed super should be aware is that effectively it's not the super fund that's borrowing to purchase a property. It's actually, they have to set up a bare trust, and that bare trust owns or borrows to own that asset. So it's quite a different arrangement. It does require generally some legal assistance to set up that trust. And also, I guess, between the different lenders, obviously fees are totally different, the criteria are totally different,
Yeah,
but there has been an increasing trend towards increasing LVRs. Nowadays you can borrow 80% LVR, whereas when 4 years ago when the products first came out, obviously they were a lot lower than that. So it's meant it's a lot easier for your average investor to access property within a super fund. So if you say you're buying a $500,000 property at an 80% LVR, I mean the fund would need $100,000. The average fund balance at the moment within self-managed super is around $800,000 to $900,000, but the median is about $500,000. So if you say you've got the median fund at $500,000, they might want to allocate 20% to self-managed, to direct residential property within their fund. So that's $100,000, and at that 80% LVR, that works. So it's sort of the numbers are now meaning that it's a lot easier for your average fund or your median fund to access direct residential property.
And what we've seen in the industry over the last, say, even just the last 2 years, there's been a big surge on the SMSF lending, and the funders or the lenders or the banks have, I guess, opened it up. Before, you would never have seen 100% offset being offered on an SMSF borrowing product. Now you do. Of course, there's no redraw. You can't have, I guess, construction. It has to be an established or a new property. The average loan, I find an interesting stat, is the average loan for an SMSF product is $300,000 to $350,000. So you made a comment before, Ben, about the median being 500. I think that's a good benchmark for a property purchase in something like this.
Sure. Okay. So what are some of the different options and strategies that people have for investing?
Yeah, well, they usually, with the strategies, they would probably sit down with their financial planner. But what we see out there is in regard to the interest rates being, now they're variable. They were always, they're always variable, but we were talking before we came on that it was always higher. So there's now fixed rates. So the strategy is, it could be investing in the SMSF, but now having a range. Before, you know, a lot of the borrowers or the clients just had shares in there. So an investment strategy is now that mix that I spoke about before. They can have direct property coming in there. They can have something else, so they have the control. And a lot of them sit down with their planner or even their accountant and sit down and actually build a strategy around the SMSF side. And property is a very big component of it in this day and age, and we can only see it going higher and higher. I mean, fixed 3-year rate at 6.2. Before, when they very first came out, no one really got it right. Everyone was quite confused, including the lenders, probably even the government was very confused. No one got it right. So the interest rates were quite high. Were they attractive? Not really. Now it's coming back into play. It's a very attractive way to go.
You know, I agree with that. I mean, it's interesting because we've had a convergence of factors. I think we've had, obviously, the underperformance generally, the stock market, and probably a lot of self-managed super. Part of the reason they've been set up, and we certainly hear this, is that they'd like to have a little bit more control of their fund. And there's that sort of tangibility that goes with residential property, but combining with, you know, lower interest rates, we can get, you know, relatively low short fixed term rates. We're seeing rental incomes grow dramatically from property. You know, rental yields are where they were 10 years ago now. Affordability is actually back to where it was in 2002. So, you know, the percentage of somebody's income that would need to be applied to servicing a loan on a mortgage is back to where it was in 2002. So it's a lot more affordable to hold a property. Given, you know, if you hold a property within self-managed super as opposed to in your personal name, a lot of people traditionally have negatively geared. So that means if somebody's on a higher tax income, they're using negative gearing to reduce their tax payable. Within the super fund environment, obviously some of the benefits are that you will not be subject to the same level of CGT. You know, it'll either be 15%, or if you sell it after you've gone into the pension phase, it could actually be 0% capital gains tax. So that's very attractive for people. Also on the income that you earn, so if you have a situation where you're negatively gearing, it may be better suited outside of super, and if you're positively gearing, it may be better suited inside super because you'll pay less tax on that income that you would earn from that property. So what we're seeing is there's a trend towards properties that sub $500,000 bracket, often where they've got you know, higher income generation, such as apartments. So where there's a higher yield associated, because there's less benefit to negative gearing in the self-managed super environment. So, but it's becoming a big component of people's properties. One of the things that's we're seeing within the financial planning industry, and a lot of our clients are financial planners or accountants or other mortgage brokers and so on, and they're trying to find a solution to offer property to their clients because it's coming from the client seeking, you know, to have that opportunity to bolt it into their fund.
Where we're seeing a bit of a surge is from the self-employed. Before, I mean, it's quite common knowledge that self-employed really don't contribute much, if at all, to super. So this has given the self-employed people out there, or businesses out there, I guess, an opportunity because they're planning. So they're saying, okay, the banks are saying, okay, you haven't contributed before, so the serviceability we can't really calculate. But if you sit down with a professional like a financial planner and say, okay, what's your projections going forward, and then you start putting it into the super, we will take that into calculation for allowing you to get a loan to buy direct property. So what we're seeing is a surge in the self-employed businesses or self-employed people going into direct property, opening up self-managed super funds because, again, it's been allowed to open up, be more streamlined and be more accessible.
You mentioned the capital gains tax before. Are there any other tax benefits or implications that investors should be aware of?
Oh, there would be definitely. Again, the accountant would be able to nail this in a hit.
Yeah, it's a very detailed piece of legislation, and I guess neither Tanya or myself are specialists in self-managed super. It's just a large percentage of our clients come from either advisors in that sector or direct investors in that sector, and so we're exposed to it. But it is quite a complex piece of legislation. There are a number of ways that people can move assets into a lower tax environment, being self-managed super, and do that in a compliant manner, but it does require technical and specialist advice. Sure. But there's certainly ways to reduce the overall tax bill by using strategies to move property that you have outside of super into super. And certainly in the long term, if you believe that property in future will be worth more than it is today, then logically you'd like to have a lower tax bill, so it's a good place to hold those properties.
It is. It's a low tax environment.
Sure. And you also mentioned, in the past and currently there's good yields and there has been capital growth. What are both your outlooks for the future for property? What are the key drivers that people should look out for?
Oh, gee, I'm a big fan of position. But then over the years, I guess the return, probably a bit of both. I believe I'm very positive about the outlook going forward in property. This will only enhance it. You would probably know more about the stats on the property side than I would, Ben.
Yeah, look, a couple of the big, and we've got, if somebody would like more information, I'll just touch on it briefly, but to get on our website, www.futureestate.com.au, we've got a section there, an education section that has a number of ebooks and research reports. One of the biggest themes that we're seeing is obviously this undersupply of housing, and there's a couple of factors driving that, but the biggest factor is population growth. Net population growth for Australia has expanded dramatically, so we're now seeing over the past few years we're well above that long-term trend, and we peaked at over 400,000 people moving to Australia in 1 year, and we're around about 350,000 people in the last year, and it's likely to be higher again this coming year. So we've got a situation where a lot of people are moving, so that's usually skilled migrants under 457 visas, and the policies have changed, which have made it a bit easier for people to migrate to Australia. We're also seeing less Australians migrate overseas, so we're seeing a situation where the annual population growth per annum has accelerated, and combined with a situation where the amount of dwelling completions has reduced substantially. So we're not building enough housing to cater for the expanding population. That's really been a trend we've seen since about the mid-2000s. We've now got a situation where we're about 250,000 houses short compared to where we need to be, so we've got this housing shortage. If that trend continues at current rates, it'll reach 600,000 houses by 2030, and that's obviously a large number in a country the size of Australia. So I guess what you'd see as a symptom of that undersupply is rents. So we've got a chart that we could send through anyone who would like to see, it might be on the BRR website, where the growth in rents has actually accelerated. So if you take 5-year periods, we've seen a situation where in the last 5 years across the capitals, rents have grown at an average of 8% per annum, which is well above the levels that they normally grow at, and it's a function of there not being enough rental accommodation. And if you break out the different sectors of the market, it's the luxury end of the market that's underperformed, and that midpoint of the market, the sort of what the average Australian can afford to rent and can afford to buy in a reasonable sort of location, has performed pretty well, and particularly from a rental perspective, if you're an investor, it's that return's starting to accelerate.
And just some closing remarks from each of you. For those investors who've historically just looked at shares, what are the key points of why they should look at property?
Well, I personally believe there should be a mix. The share market is, as we all know, has just crashed and burnt, and I think that's going to take quite a while to even get back onto an even keel. A property is a really, really good alternative, and it gives the client or the consumer the balance that they really require in this ever-changing landscape.
And Ben, closing comments?
Yeah, look, in terms of somebody's portfolio, obviously people need to have a balanced portfolio, and we're not a financial advisory group, but a lot of our clients are, and they choose to work out with each individual client what best suits them, but obviously it should be a component of somebody's portfolio, and we wouldn't recommend that it's entirely somebody's portfolio, but we're seeing a trend towards people wanting to have 10 or 20% within their fund in direct property, and that obviously the share cash bond mix that is typically made up of.
that just about wraps things up as we're out of time. But thanks to our guests, Tanya and Ben. Thanks for joining us.
Thank you, Michael.
Thank you, Michael.
Okay, I'm your host, Michael Killicoat. Thanks for viewing today and look forward to seeing you for the next instalment of the BRR Media Industry Roundtable series.